Hi, everybody. This is Peter Schiff. Well, yesterday we got the government's first estimate of the second quarter GDP. And of course, all of the pundits were looking for a big rebound from the very weak 1.1% growth that the government claimed was recorded in the first quarter. In fact, the consensus range went from a low of 2.2 to as high as 3.4. So a lot of optimism going into Friday's release. When we got the number, everybody was surprised by the fact that it was only 1.2%, substantially below even the lowest estimate that anybody had. In fact, adding insult to injury, they made a lot of revisions to prior numbers, some up, some down. They went back a couple of years, but most significantly, they revised the last two quarters down. The first quarter, which had been reported as up 1.1, which was still very weak, they revised that down to just 0.8. And the quarter before that, the fourth quarter of 2015, that was reported at 1.4. That one went all the way down to 0.9. And remember, that's the quarter where the Fed decided to raise interest rates for the first time in about, 9 years. The Fed said that they were data dependent and that the data was finally good enough, that the economy finally looked strong enough for the Fed to raise rates, when in fact the economy was slipping back into recession. If you look at the last 3 quarters of economic growth, the average is actually slightly below 1%. And that's assuming that the 1.2% number that we just got for Q2 actually holds up to scrutiny in the future. My guess is, just like the last 2 quarters, this quarter, or the most recent quarter, is also going to be downwardly revised. And of course, all of this means that you have to buy the government's version of inflation. Because remember, the nominal GDP numbers are always deflated. The government has to subtract out inflation. And the number that they claim the inflation rate is so ridiculously low as to be beyond belief. If we had a more realistic inflation measure, I think that not only would the second quarter have come in negative, but the 2 prior quarters as well, and we would already be in recession. But who knows? At some point in the future, the government may revise all of these numbers much lower, and they will be able to officially concede that this greater recession that I believe we're already in actually started in the fourth quarter of 2015, the very year or the very quarter that the Fed basically waved the all clear on the economy and decided to raise interest rates. Now, of course, as soon as this weak number came out, all of the pundits were trying to rationalize why it didn't matter. One of the things they pointed to was the strong consumer, because consumer spending was the lone bright spot in this report. It jumped up by 4.2%. Now, that is a big number. There have only been 2 other quarters where the number was that large since this supposed recovery began in 2009. But both of those quarters were in the fourth quarter. And we all know that the fourth quarter is when consumer spending really picks up, because that's when everybody does all their Christmas shopping and there's all the big holiday sales. If you want to find a quarter where consumers increased their spending by this much when it wasn't a fourth quarter, you got to go back 10 years. Now, to me, that suggests that this number is probably not accurate. I don't see anything in the economic data that would suggest that consumer spending is that robust. So I think they're going to revise down that part in particular in future months, which means it's not that this is a bright spot that we should be optimistic about, but I think that bright spot's going to be rubbed out. I think it's going to go down, and so the number is going to get even worse, especially if you look at other things that are going to be weighing down on the consumer, especially in the future, which is going to be the rise in consumer prices. That's going to be accelerating. I think the economy is going to be weakening. In fact, I saw an interview with Alan Greenspan this week on Bloomberg. His official forecast is stagflation. He's very worried about weak growth and accelerating inflation, and I think he's even more worried than he lets on. After all, he helped let this cat out of the bag. He was the architect of this policy, and he ought to know why it's going to fail. So rising consumer prices and a stagnating economy is going to weigh on consumer spending, especially if we start to see layoffs picking up later this year and throughout next year, which is something that I anticipate. Another reason that analysts were so quick to dismiss this number is because they noted the big drag from inventories, that inventories are coming down, and analysts said, well, this is just a one-off event, and we expect this number not to be a drag in the future. It is hardly a one-off event. It was inventory building that was helping to pad GDP in the prior years. And if you remember from these video blogs and my podcasts, I said that businesses were making a mistake in building up their inventory. They were overestimating the strength of this recovery or the ability of their customers to afford their products. And now we're paying the price for that. And if you look at the inventory to sales ratios, they are still ridiculously high. So this is just the beginning of a trend in companies winding down their excess inventory. So rather than just dismissing this as a one-off event, this is the beginning of a series of negative impacts on GDP from reductions in inventory. So the news is bad and it's going to get worse. And I think it's particularly ironic that it came out just 2 days after the FOMC minutes were released, or not their minutes, the statement from their last meeting. They met this week on Tuesday and Wednesday. And on Wednesday at 2 o'clock, they announced, surprise, surprise, that they were not going to be raising interest rates, but they said that the outlook for the U.S. economy had improved, I assume, since their last meeting. And because they said that the outlook for the economy had improved, everybody meant, oh, that means they're getting ready to raise interest rates. I think Goldman Sachs came out and officially significantly increased the probability for a September rate hike. Right? So based on the Fed's optimism, quickly the markets put a September rate hike on the table. I don't think it was ever on the table, but obviously the weak GDP number just took it off the table. But again, the Fed looks more and more ridiculous. It just talked about why the outlook for the economy was improving, and we just substantially reduced it, not only with the much weaker than forecast GDP, and of course much weaker than what the Fed was forecasting too, not just private analysts, but the two downward revisions to the prior 2 months. Now all of a sudden, the Fed was completely wrong just 2 days prior to the GDP numbers. And of course, when the Fed comes out and talks about the U.S. economy strengthening, it's all part of what I've been calling their loud talk, no stick policy. And of course, this goes back over 100 years ago to Teddy Roosevelt, and he had a famous big stick policy where the words were speak softly and carry a big stick. Well, what the Federal Reserve is doing is they're talking loudly and carrying no stick. And they're hoping if they talk loud enough that nobody will notice the absence of a stick. So they always want to talk about why the economy is strengthening and why they anticipate future rate hikes, because rate hikes are the stick that they want everybody to think they have, but they don't have one. But rather than using it, they want to talk about using it. The opposite of what Teddy Roosevelt thought. His defense policy, look, we're going to have such a strong defense, no one's going to mess with us, and we don't have to say anything. I mean, we're going to speak with our Navy. People are going to see how strong we are, and no one's going to pick a fight with us. What Janet Yellen is doing is trying to make sure that people don't notice the absence of the stick with all their loud talk. Well, obviously, that talk gets silenced every time we get GDP numbers that come out this week. Of course, the main question is, when are the markets going to figure it out that the Fed is all talk and no stick, and not react to these statements the way they did on Wednesday? Meanwhile, the market reaction on Friday to the much weaker than expected GDP number was pretty swift. The dollar tanked. The dollar index dropped better than 1 full point. We're now back at around 95.5. But again, the dollar is still considerably above the lows from a couple of months ago. I think all of those gains need to be surrendered. I think it's a long way down for the dollar. Gold, on the other hand, hit a new high. We closed above 1350 on a monthly chart for the first time this year, just barely above it. Silver closed above 20 cents. This is also the first time, or excuse me, $20 an ounce. This is also the first time silver's been above 20 on a monthly closing basis. Gold stocks also finished the month on the highs. Not only is this a new high for the year on the gold stocks, it's a new high for 3 years. I think what's happening there is a lot of the losses that gold stocks never should have endured are being recouped. Because remember, gold stocks were looking forward, and all of the experts were convinced that the price of gold was going much lower, and so they sold off the gold stocks, not based on where the price of gold was, but based on where they expected it to be. And as those expectations are proving false, they're having to re-rate these stocks, and they're just catching up and recovering the ground that never should have been lost. But I still think there's a lot of upside in gold and gold stocks and a lot of downside in the dollar, particularly as more bad economic news comes out to reinforce the idea that rather than tightening interest rates, the Fed is going to reduce them. Right now, everybody is speculating, when will the Fed hike again? How much will they hike? Once people start to realize that the real questions are not when is the Fed going to hike, but when are they going to cut? And will they stop at zero? And will they do QE4? I think the answer to all three of those questions is yes. The only unknown is how big QE4 is going to be. I think it's going to be massive. Just to give you an example of how bad things really are, let's look at some of the other economic news that came out during the week that the markets really ignored. First of all, June durable goods dropped by 4%. I think that was the biggest decline in about 2 years, and it fell from a upwardly revised or downwardly revised drop from May. It was originally reported as a drop of 2.2. Now it's a drop of 2.8. Year over year, we were down 6.4%. And if you look at the year over year core capital goods number, that was down 3.7. That was the 18th consecutive year over year monthly decline in core capital goods. This has never happened unless the U.S. economy was in a recession. This is the longest streak of year over year declines outside of a recession, which is more of an indication to me that we are in a recession. We're just not acknowledging it because the data that's coming out is so weak that you only see data like this when you're in a recession. Also, Ford dropped the bombshell. They announced a 9% decline in second quarter profits, and they warned about a weakening outlook for domestic demand for automobiles. And remember, the auto bubble, particularly because of the subprime lending that's been going on in the automobile market, the auto bubble has been a big part of this phony recovery, and now it's deflating. And of course, everybody wants to claim credit, including President Obama, for the success of the U.S. auto industry. Well, the success was built on a mountain of subprime debt and cheap money supplied by the Federal Reserve. I wouldn't be surprised the next time we have an economic downturn that you're going to have to see government bailouts again of the U.S. automobile industry. It's not that the bailouts worked. It simply preserved the problems that led to the collapse in the first place. And I think it's going to happen again. Now, I think Ford didn't get a bailout last time. It was just GM and Chrysler. But I think next time around, it might be all three that are going to need a government bailout. Also, we got a report out on the health of the restaurant industry, and it didn't look good. Second quarter sales have been horrible at restaurants. Even the fast food like McDonald's had a very weak second quarter. But it's not just fast food. It's the entire restaurant industry that is showing a decline. Consumers are basically too broke to dine out. The last time we saw a quarter like this in the restaurant industry was in 2000 and in 2007. And if you remember, what happened after 2000? We had the 2001 recession. What happened after 2007? We had the Great Recession of 2008. So now all of a sudden, Americans are behaving, at least with respect to dining out, exactly the way they did just before the last two recessions. And one of the other reasons why weakening restaurant industry is so important this time around is because the jobs recovery that everybody is talking about, well, it's been powered by the restaurant industry. Waiters and bartenders have been the locomotive of the Obama job creation train. And of course, a lot of these jobs are part-time. Probably most of them are part-time because nobody hires full-time workers anymore, thanks to Obama. So we have a lot of part-time workers. But if the restaurant sales are falling, restaurant layoffs can't be far behind, especially since so many part-time waiters have been hired over the last couple of years. If it turns out that there's not a lot of demand, you're going to see a lot of layoffs. And this sector is going to be particularly hard hit by the increasing minimum wage, not only the minimum wage hikes that have already taken place, but the minimum wage hikes that are in the pipeline for the future. So I think we're going to see some significant downsizing in the restaurant space, a lot of layoffs. So all of this is going to weigh on the economy. This recession is just getting started, but I think it's going to be much bigger than the Great Recession that we just left in 2009, which means they're going to have to rename that one or maybe call this one the Greater Recession. Another piece of news that should have been disturbing to everybody who wants to talk about how great the U.S. economy is comes in home ownership. The home ownership rate just took another drop. It was at 63.5%. It's now down at 62.9%. That is the lowest home ownership rate since 1965. You're going back 51 years to find a home ownership rate as low as it is right now. Now, I think the rate is going to go below 60 over the next few years. The first time the home ownership rate in America got above 60 was in 1955. So I think we're actually headed for a 60-year low in home ownership. And who knows how much more it's going to drop based on the nature of this economy. You know, the home ownership rate prior to, let's say, the 1930s, 1940s, it was really around 45% or so. It really started to move up in 1942. And, you know, the reasons for that were twofold. One was the government started getting very involved in home ownership. They started the FHA in 1934, and then they started Fannie Mae in 1938, and then in 1970, Freddie Mac. So the government started subsidizing home ownership. And that's one of the reasons that the rate was driven higher. But another reason was the income tax, which very few Americans paid until 1942. And in 1942, as part of the victory tax, we had a withholding tax. And now, for the first time in history, average Americans started paying the income tax. And of course, as we were coming out of the Great Depression and we ended the Second World War and the GIs came home and they got jobs and they wanted to reduce their taxes, well, they would buy a house and get the home mortgage deduction. So you had all these government subsidies, from the income tax to direct subsidized and guaranteed mortgages, that drove the home ownership rate up from about 45% just before the Second World War, all the way as high as over 69%. That was the 2005 peak. 60, just over maybe 69.2, I'm not sure exactly, but it was higher than 69. And it's been collapsing throughout the entirety of the Obama administration. And this is despite all of the government's efforts to encourage home ownership with government guarantees and, you know, very, very low down payments and record low mortgage interest rates, thanks to the Federal Reserve, which is another reason, right, why the Federal Reserve can't raise interest rates. Because if they raise interest rates, right, then the home ownership rate is going to plunge even more, because the most important factor determining whether or not you can afford to buy a house is your monthly mortgage payment. And obviously, the monthly mortgage payment is extremely dependent on interest rates. Now, of course, if interest rates went up, real estate prices would crash. And I think a collapse in real estate prices is a much better way to encourage home ownership. Yes, you have a higher interest rate, but you don't have to borrow as much money because the price of the house is much lower. That is the market solution to this real estate problem. But the Fed won't allow that because it has to keep the asset bubble inflated. It has to continue the wealth effect. It has to keep the banks propped up. See, the Federal Reserve cares more about the home equity for people who already have homes than about the desire of people who don't have homes to buy them. So their whole thing is about propping up the bubble and maintaining the phony illusion of wealth and maintaining the phony balance sheets of banks. So expect the home ownership rate to continue to fall. And you know, when a lot of people talk about how the people have increased or they have fixed up their personal balance sheets, that there's not as much debt on the average American's balance sheet as there used to be, that's because there's no mortgage for a lot of people. But not only did they lose that big liability, they lost their only asset, which was their home equity. But if you actually look at debt outside of mortgage debt, look at auto debt, look at college loans, look at credit card debt, it's off the charts. And incomes have been steadily falling. So if you look at all that debt relative to diminishing incomes, you see an economy in massive stress. Also, we got news on merchandise trade. Our gap widened in June. 63.3 billion was the most recent number. That was better than 2 billion higher than had been forecast, and it was a jump from an upwardly revised 61.1 billion in the prior month. So larger merchandise trade deficits also reflect a weakening U.S. economy that is less productive, and of course the trade deficits are a bigger drain on U.S. GDP. Also, we looked at the domestic oil inventories, which continue to decline. This is despite a decline in production, and what that's telling us is the economy is using less energy. Well, if the economy is using less energy, it's obviously not growing. In fact, it's probably contracting because energy is a very important ingredient to economic activity. The more the economy is producing, the more activity, the more energy is being consumed. The fact that that's not the case is a very strong suggestion that the economy is much weaker than everybody thinks. And of course, nobody wants to admit how weak the economy really is. Certainly the Federal Reserve doesn't want to admit it because the Federal Reserve is on record of predicting a strong recovery, and they don't want to admit that they were wrong, but also they don't want to admit that their policy was wrong. They don't want to admit that their quantitative easing policy and 0% interest rate policy was ineffective. So in order not to admit that, they have to pretend that the economy responded well to their medicine. They don't want to acknowledge that it's sicker than when they started. So they're going to continue to maintain the pretense that all is well until they can eventually blame the renewed problems on some external factors that were beyond their control, and then they can go back to the same toxic medicine that made us so sick. But it goes beyond more Fed credibility. It's also politics, right? The Fed doesn't want to undercut Hillary Clinton because Hillary Clinton is running on a message of how successful Barack Obama was in his presidency, how great the economy is. And Janet Yellen wants to pick up that baton and run with it. She's campaigning for 4 more years of the Obama administration, and so nobody wants to acknowledge what a failure it was when it comes to the economy. Certainly Janet Yellen, she wants to help Hillary Clinton become the next president. She wants to stay on as Fed chairman. And of course, this is particularly important considering who the Republican nominee is and what his message is. Donald Trump is talking about how bad the economy is, and the Democrats want to pretend that that's a lie. They want to pretend that he's just painting this gloom and doom picture of the economy, trying to scare people, but the economy is really great. Well, if Hillary Clinton wants to run on a platform of how great the economy is, and let's continue it, how is Janet Yellen going to admit that we're back in recession? How is Janet Yellen going to admit that the economy needs more stimulus, when in fact that is exactly what it needs from the Keynesian perspective of the Fed? Because I believe that if this wasn't an election year, the Fed would be already cutting rates. The problem is, of course, there's not a lot of room to cut because they barely raised them in the first place. So the only tools they have left really in their arsenal beyond negative rates, which are probably coming at some point after the election, and QE4, is to just change their rhetoric and maybe try to convince the markets that rate hikes are coming later rather than sooner, to try to prop them up. Because again, one of the things that Hillary Clinton is going to be campaigning on to prove that Donald Trump is wrong with his dire assessment of the U.S. economy, which, by the way, I think he's sugarcoating it. I think it's actually worse than he says. But they're using the strength in the stock market to try to fool voters into thinking that there's a healthy economy. Hillary Clinton wants to pretend that the economy is generating all this wealth. She just wants to redistribute it to her voters. Her point is that the economy is great. We just need to share the wealth more. We have to take it away from some of these greedy rich people, the billionaires and millionaires, and just make sure the middle class and the poor get their fair share. But the reality is the pie is shrinking, and the Federal Reserve doesn't want to acknowledge that. Janet Yellen doesn't want to undercut the Democratic message. Well, that's it for today. Make sure to tune in to my podcast at shiftradio.com and right here on this YouTube channel for more frequent updates on what's going on in the markets, with the economy, and in the political scene. Bye for now.